Capital gains tax is even worse than you think. Taxing unrealized gains on superannuation accounts above $3 million is bad policy for reasons I'll touch on in a moment. But what I'm not hearing people talking about in the mainstream media or anywhere is that capital gains tax in principle, simply as a concept, inside or outside of superannuation accounts and on unrealized or on realized capital gains, just as a concept, it is way, way worse than we think. Because in the end, capital gains tax is actually a tax on inflation. And when you understand that, then you'll understand why the government keeps printing money and pumping housing prices, and why they are so terrified of deflation or of stabilizing housing prices, because either of those things would blow a gargantuan hole in the budgets of the federal and state governments respectively. My name is Topher Field. This is the Topher Project, and I help busy people like you to think through complex issues and keep up with the world as it changes around you. I am 100% viewer supported, so please head over to goodpeoplebreakbadlaws.com and grab a copy of my books, my DVD, or my merch, and you'll be helping me to continue producing content like this. And if you've already got my books, my DVDs, and my merch, and you'd like to support me some more, then please head over to topherfield.net and use the Buy Me a Coffee button to, buy me a coffee. Thanks for your support. I love doing what I do, and your support helps me to keep doing it even more. Now, back to this tax on inflation. There is a huge amount of discussion about the proposed capital gains tax on unrealized gains in superannuation accounts above $3 million. And we can expect this to be rammed through into law now that Anthony Albanese has been given another term as Australian Prime Minister. And yes, that tax is a terrible, horrible, no good idea because unrealized gains are not liquid. So if, for example, I had shares and they went up in value, I don't have more cash in the bank with which to pay a tax bill on those shares. So the tax that is payable is going to force me to sell some of those shares to liquefy that asset so that I can pay the tax bill on the rest. And whilst that may not seem like a big deal, actually, it's a way bigger problem than we realize. But even that is nothing compared to the problem of capital gains taxes in the first place. But I do need to deal with this proposed new unrealized capital gains tax first before I get to the real problem underneath that, because this new tax on unrealized gains is the topic of the moment. So let me deal with it. And then, honestly, as bad as that is, it's not the real problem with capital gains taxes, but we will get to that at the end. All right, firstly, you have to realize that if we allow the taxing of unrealized gains inside superannuation accounts, then it will not take long at all before that is extended to unrealized capital gains inside trusts or inside companies. And ultimately, yes, it will be extended to family homes. Now, politicians will of course deny that they would ever do such an irresponsible thing. But we only need to look at the history of taxation to know that this scope creep of taxation is inevitable. Governments have an insatiable appetite for money. The world is not enough for them. And over time, no matter how much we give them, they will always come back for more. Consider, for example, that income tax was supposed to be only temporary, and only to pay for the war effort, and only on the very rich. Now it's permanent and applies to almost everyone. Taxing unrealized capital gains is an absolute honeypot for government if we allow it inside superannuation accounts, and they will very quickly figure that out and apply it everywhere else. Secondly, whether inside superannuation accounts or not, taxing unrealized capital gains forces the sale of part or all of the asset. So it will no longer be possible to invest long-term in anything, because sooner or later the tax bill will force you to sell. The example of shares is actually the best case scenario because you can sell only part of your share portfolio. You can sell a few shares to pay taxes on the rest, but that is not true of properties. If you own a house in your superannuation fund, or give it a decade or so, if you own a home in your own name, you can't sell part of that house to pay the tax on the unrealized capital gains on the entire property. So, for example, a median house in an Australian capital city is now around $1 million, thanks to inflation, and a 7% increase in nominal value in 1 year is a relatively common increase. So that's a $70,000 capital gain. Now, this new unrealized capital gains tax inside superannuation accounts is 15%. So if you own this house in your superannuation account, you'll get slapped with a tax bill of about $10,000 for the unrealized capital gains on that. And you have to come up with that even if you don't sell the property. So if you're still working, then you're having to find that tax money out of your salary or from somewhere else inside your superannuation account. Now, if it comes from your salary, well, you're already being taxed on your income. If you're earning a lot of money, which would explain why you would have $3 million in your super to begin with, then you're already presumably on the highest marginal tax rate. So in order for you to pay a $10,000 tax bill, you need to earn nearly $20,000, pay income tax on that to be left with a little over $10,000, so that you can then hand that $10,000 over as tax on a property that increased in its on-paper value in your superannuation account. And all of that money will be handed over to the government in taxes in a single year, every year, for the sin of owning an investment property in your super account. An account which, let's not forget, was the government's idea. The whole point was to get people to fund their own retirement rather than relying on welfare. So the government is literally penalizing people for doing what the government wanted them to do, but doing it a little too well. And people will either be selling their investments piecemeal just to fund the tax bills, or they'll be handing over ever more of their hard-earned salary, hurting their quality of life and also further damaging private sector economic activity, making it harder for the rest of us to make a living. All because they gained value on paper inside an account that they can't access until they retire. But even still, that scenario that I just described is actually a best case scenario. What about the retirees who no longer are in the accumulation phase of their superannuation account? They are rather in the pension phase. They no longer have a salary or another income out of which to pay these new taxes, except for the income from the superannuation account itself. And that, of course, the superannuation account is the thing that is being penalized. It's a snake eating itself. Understand, capital growth of assets is literally the point of a long-term investment account like a superannuation account. We put the money into shares or property or whatever, literally because they increase in value over time, and they do so at a faster rate than inflation, ideally. Whereas cash in the bank loses its value over time due to inflation. So capital gain of investments is literally the point of a superannuation account. That's why it works. And that's why the government introduced superannuation accounts in the first place. And yet that capital gain is now the very thing they are looking to penalise. So a retiree, well, they still need the assets in their account to keep growing. Because in an ideal scenario, a superannuation account will have enough assets for a retiree to live purely off the proceeds. Now, that might be share dividends or rental returns or whatever. Ideally, the aim is that a retiree does not have to sell down their assets little by little each year, because if they have to do that, then the value of that account is going to decay with increasing speed over time. And if they do that, then there is only a finite amount of time before that retiree runs out of their superannuation account and is back on welfare, which isn't good for them, and it isn't good for us, and it defeats the purpose. So the point of a superannuation account is the capital growth, which stops the government from having to pay out welfare. Now, even in retirement, capital growth is still the point, not just when you're working. In retirement, well, you could be retired for 20, 25, 30 years, and you need money. You need income. Capital growth during those 20 or 30 years is part of the point of a superannuation account. And if a retiree is actually going to keep up with the rising cost of living, or in other words, keep up with the effect of inflation, then they really need to be able to leave those capital gains inside their superannuation account so that every year their account actually produces more money, so that they don't have to keep reducing their quality of life year after year after year as the cost of living goes up or as the value of their superannuation account decays. All right, that's a lot of theory. But given that capital growth is literally central to the whole superannuation thing, what happens if we start taxing the unrealized capital gains inside those superannuation accounts of retirees? Well, in most cases, all we're going to be doing is sucking the cash flow and the assets out of that superannuation account at lightning speed. At a minimum, we're just going to be asset stripping this retiree who, in obedience to the government, accumulated assets in their superannuation account. In practice, it will make superannuation accounts nearly redundant. as retirees are forced to sell off their own pension in order to fund the taxes on their assets. And a huge proportion of self-funded retirees will just end up back on the government pension because the assets which were enough to retire on indefinitely were not enough to retire on and fund the government's latest money grab. In other words, taxing unrealized gains inside superannuation accounts will, at least in part, defeat the purpose of superannuation accounts, turning them from you saving for your retirement into you saving for the government's budget. So that deals with the whole unrealized capital gains thing. And finally, we can get down to business. Because capital gains tax, even on realized capital gains, or in other words, even on assets that you have sold, is just a tax on inflation. Let's step aside from the superannuation account scenario and just look at you as someone who maybe owns a few shares, or maybe you own an investment property. Whenever you sell any of those investments, the government steps in and demands capital gains tax on any profits that you made. Now, in simplified terms, if you buy an investment property for $500,000 and sell it a year later for $550,000, you've made a profit of $50,000. And in layman's terms, that $50,000 gets added to your assessable income for that financial year, and you have to pay tax on it as if it were part of your salary. So the tax is calculated at whatever the relevant income tax bracket is for you and your situation. And yes, for those that are in this space, accountants, etc., I am absolutely simplifying. Yes, the cost base of the asset includes the acquisition costs such as stamp duty. And yes, if you held the asset for more than a year, you'll get a 50% discount on your capital gains tax, which is kind of like the mafia giving you a 50% discount on a kneecapping. But all of that is just noise. The bottom line is, if you are an active property or share or property precious metals investor and you buy and sell investments, you're going to get stung. So if you have a $50,000 increase in your assessable income, that means that you'll have about a $15,000 to $20,000 increase in your tax bill, depending on your tax rate. But notice, if property goes up faster, the capital gain gets bigger and the tax bill gets bigger. But that's because you're making more money, right? Well, only partly. What if inflation spikes due to excessive government borrowing and spending? Let's say inflation spikes up to 10%. Well, then your house price will increase maybe 15%, right? Inflation plus a little bit more. Your profits when you sell jump up proportionally. And then you get taxed on all of that increase, but actually a bunch of that alleged gain was just the effect of inflation. It wasn't the house going up in value, it's your money going down in value. But now you're going to pay more tax on that investment because your money lost more of its value. The higher the inflation rate, the higher the capital gains tax revenue for the government. Now, for anyone that's new here, inflation is driven primarily by money printing and reductions in productivity. But inflation actually helps the government. So it's effectively a punishment on the productive class for the crime of having savings to the benefit of governments and their big borrowing lifestyle, their debt. If you as a productive person keep money in the bank, you get penalized by losing a few percent of the purchasing power of that money every single year. So what do savvy investors do? Well, they move that money into assets that give them a hedge against inflation, things that tend to increase in their nominal dollar value at least as fast as inflation. This might be shares or property or precious metals or all kinds of different things. And let me be very clear. I am not a financial advisor, and none of this is financial advice. I'm not suggesting what you should do, or indeed that you should do anything. I'm simply providing commentary on the effects and realities of capital gains tax as a concept, nothing more, nothing less. So, in Australia, if you invest in an asset that shelters you from inflation, that means that at least in nominal dollar terms, the asset is increasing in value, which means that when you sell that asset, you're going to be stung with capital gains tax. And that means that you are still paying for the inflation. The higher the inflation was while you held that asset, the higher your alleged capital gains will be, and the tax bill will reflect that when you sell. So if you invest wisely, well, yeah, you'll still be better off than you would be if you just held on to cash for that time. But don't think for a moment that you're not paying the price for inflation. Capital gains tax is a tax on inflation. And now you know why governments love to keep inflating our money away. Not only does it help them to reduce the effective value of their existing debt, it also props up their revenue through a mix of income tax bracket creep and capital gains tax federally, and through the rapid rise of stamp duty revenues and land tax revenues at a state level. There is a common saying that taxation is theft, but I don't actually think that's true. I think taxation is extortion because it's done openly and with the threat of violence if you don't comply. But inflation? Inflation is theft because that is done stealthily and you don't realize what's being taken from you until after it's gone. Taxing unrealized gains in superannuation accounts is a terrible, horrible, no good idea. But that's because the very concept of capital gains tax is a terrible, horrible, no good tax, which creates an incentive for governments to destroy us doubly through relentless inflation, which, thanks to capital gains tax, we cannot effectively shelter ourselves from. Now, I need to hark back to my recent video about Bitcoin and the Victorian magistrate who ruled that capital gains taxes do not apply to Bitcoin. Now, that decision is being appealed, of course, and we await the outcome of that. But hopefully after watching this briefing on the capital gains tax, you can now see why I believe that if this ruling is upheld on appeal and capital gains taxes are not applied to Bitcoin in Australia, I believe that will trigger a rapid acceleration in the adoption and integration of Bitcoin into the Australian economy because it would make Bitcoin one of the only true hedges against inflation. Now, we'll have to wait and see how that court battle plays out, but make no mistake, capital gains tax is just a tax on inflation, and we need to start calling it out. Or the idea of taxing unrealized capital gains will quickly spread like a cancer. Not content to destroy only superannuation accounts, it will end up hurting us all. My name is Topher Field. This is the Topher Project, and I help busy people like you to think through complex issues like this one to help you to understand the world as it changes around you. Now, I am 100% viewer supported, so if this has been informative or thought-provoking for you, then please head over to goodpeoplebreakbadlaws.com and grab books about civil disobedience. I promise you they are thought-provoking. There's my DVD of Battleground Melbourne, my merch, my online course, which is all about how to use your focus, hope, courage, faith, and community to make a real difference in your life and the lives of those around you. And in the process, you'll be helping me to keep doing what I do. Thank you for watching to the end. Please like, comment, share, check out this recommended video, and as always, stay free.